Hello, good evening, everyone. Okay, welcome to today's session. Before we begin, just very quickly, I want to go over to talk a little bit and share with you the current promotion that KVB have, right? And of course, today's session is supported and sponsored by them as well, which give us an opportunity to connect and share a little bit more about, trading. So for those of you who are fairly new to KVB, just a quick shout out. They are currently having the very unique promotion running until the end of this year, which is the 31st of December 2025. So of course, if you're new to it, right, you have not have your own personal account. The links are actually attached in the description tags that you can find whether you're on YouTube or Facebook. If you click into it, you can then, find out a bit more about it, register your account. If you have any inquiries, feel free to reach out to the support team as well. But I just want to bring your attention to the current promotions that they're running, which is a little bit unique, right? Which is called the Switch bonus, right? So what this is you click into it, you can actually find out a little bit more. But in summary, it's basically if today you have more than one account with multiple platforms, and you are new to KVB, hey, if you go and register yourself and make a deposit, right? They do have the bonus over here where you can actually receive up to 1% switch bonus, right? And up to $2,000 from that, right? Now there are more details to that where you can also double your rewards. But again, I wouldn't, spend too much time today to go into the details of this. But I just want to introduce this reward and promotion to you so that you can be aware of it and find a little bit more, right? As you register your account, click into it, that's where you can find a bit more information. Now, of course, if you need any further inquiries, feel free to reach out to the support team from KBB directly as well. Okay, so with that said, let's jump over to the content for today. Okay, so the focus of today is to share with you a little bit more about risk management, which I feel is very, very important as a trader. It's not just about your strategy, right? It's not just about analyzing the market, where to get in, and things like this, but the understanding of risk, leverage, and how do you position your trades? How do you calculate the proper sizing so that whenever you take a trade, you are taking it with confidence, um, and you very well know, what's the risk involved, right? And that's a very significant part in your trading journey. Okay, and that's something that we want to cover in today's topic. Now, of course, as we progress, if you have any questions that you would like to clarify, or there are certain things that maybe that pop up, and you just want to answer, feel free to put your questions in the comments tab. Okay, whether you're looking at Facebook or YouTube, do put that down. Then the team over here would be sharing the questions to me as well, and then from there I'll be able to answer your questions accordingly. Okay, so that's a little bit of a housekeeping. Let's jump into the topic and content, right? Now, over here, we'll start off by putting this quote here, right? Most traders lose not because of their strategy, but because of their position size, and their inconsistent leverage. Now, obviously, there's no such thing as the holy grail, or there's no such thing as like 100% win rate, right? Every strategy itself has its strengths and weaknesses, and there are bound to be losses throughout. Okay. The key here obviously is whenever you win, right, you need to make sure that your profits can easily cover your losses. Okay. And one thing that we can actually achieve that, or one tool that actually help us to achieve that kind of consistency, would be our position sizes, right? Meaning, aka risk management. How do we protect our downside and then maximize the upside? Okay, so that's something that I want you to know. And of course, in today's discussion about risk management, right? Understand that there are certain things in trading that you have absolute control with, and then there are certain things that you can never control, right? Like for example, how price is going to move, is price is going to go up or down. That's something you can control. Okay, but position sizing is definitely something that you have 100% control, right? And of course, risk management as well. Hey, so let's talk a little bit about the foundations of risk, which is some of the keywords and definitions I think every trader needs to be aware of. Okay, so the first one here is account risk per trade. Okay, now what this means is that how much percentage of your account equity or capital you're going to put at risk, right? If let's say a trade hit your stop loss, how much are you going to risk? There is no one size fit all, or there's no model answer to that, but the number has to be something very, very comfortable to you, right? So you probably hear a lot of times traders would say, oh, never risk more than 1% or never risk more than 2%. Okay. But that 1 or 2% is actually very, very kind of like not a concrete number, right? Because some traders would trade with bigger capital, some traders would trade with smaller capital. Obviously, a percentage of that size would vary too. Okay, so at the end of the day, you need to find that sweet spot in terms of like what's the exact number that you yourself is comfortable at, right? But of course, if you're working in percentage, right? Today, if your risk only, let's say 1%, that obviously is very, very, if you're very, very disciplined that, then it's very difficult for you to burst your account, right? Because in order for you to lose everything, you need to consecutive lose like 99 to 100 times, right? In order for you to lose the entire account. So that's where the logic comes from, right? Like why 1% risk per trade. Then of course, there's also the understanding of risk in terms of dollar amount, right? Because sometimes, as I mentioned, percentage of a capital really depends on how big your capital as well, right? So sometimes you also need to look in terms of like the exact dollar amount, right? Are you comfortable with that? If you're not, then obviously you need to make that adjustment to lower it. And then of course, if you're looking at that and they realize that, oh, okay, you can actually go for more, you can take high risk, you can definitely make that adjustment as well. All right, so that's risk in terms of dollar. And then we have this keyword core expectancy, okay, which is something that I feel a lot of traders are not aware of, because a lot of times traders will only look at the win rate, right? They always ask like, oh, based on this strategy, what's your percentage win? But that is only part of the formula in calculating whether the strategy is actually profitable. Okay, and the actual formula to calculate profitability is core expectancy, right? Which means based on the strategy, how much are you expected to win? Or of course, if the strategy is not profitable, then what's the negative expectancy, right? So the formula of this is basically you take your win rate, multiply by your average win, and then of course you minus off the losing rates and what's the average loss, right? Now, if you look at this formula here, basically win rates or the losing rate, right? Because they are just basically the win rate and then the losing rate just add up 100%, right? Win rate is only part of the equation, right? The other equation is what's your average win and what's your average loss. And if you kind of translate that, that is basically your risk to reward ratio, right? Today, if your win rate is 50% and your losing rate is, of course, then 50%, meaning 50-50, right? You win half the time, you lose half the time. And today you realize that if your average win is more than your average loss, actually your expectancy is going to be positive. And that means a profitable strategy, okay? So when you fully understand expectancy and you understand, okay, what contributes to a profitable strategy, it's not just your win rate, but it's also the average win and average loss, right? When you win, how much you win, when you lose, how much you lose, right? So RR is equally important in making a strategy profitable. Okay, so that's something I want everyone to be aware of, okay, which is very, very important. Okay, then we have this concept of portfolio heat, or sometimes I'll just use the word portfolio exposure, right, or total exposure. It's basically understanding that if today you are taking more than one trade, okay, concurrently, let's say you put in like 5 orders and then all 5 orders are triggered, you need to know worst case scenario if all 5 loses, right? What's the total drawdown? Okay, so that's your total risk, right? That's your total risk exposure. Okay, this is again important if you're looking into like managing a sizable drawdown, right? You want to know that if today you put in, let's say 5 trades, right? What's the worst case scenario? If that's something too big, then maybe out of the 5 trades, you want to reduce it to maybe 3, maybe to 2, or reduce your position size, right? So that's what I mean by exposure. Okay, and then we have this term called maximum drawdown. So to understand drawdown is basically what's the worst case scenario, right? Today, if you have, let's say, you start off with 100% capital, right? And then you start off, let's say, losing like a couple of trades, and then your capital starts to drop. All right. So drawdown is basically a measurement of like the peak, which is the highest equity that you have, to the lowest equity, right? What's that percentage loss? This is important because while you start trading, right, and throughout your journey, you want to have a figure that you're comfortable with in terms of your maximum drawdown. Like, okay, so some traders would say, oh, I'm comfortable losing like 20% of the account, right? Some traders would say, okay, I'm comfortable losing 50%, half of it. That's not right or wrong, but this figure is very important because then that would guide you in understanding and calculating what is the risk per trade you should be taking to maintain within your maximum drawdown, right? So I can give you an example, right? Of course, as we go through today's session, you gain more clarity of that as well. So what do I mean by that is today, if you give example, right? Today, if you have a 20% maximum drawdown, okay, and then you think statistically, um, it's very difficult for you to hit like 20 consecutive losses, right? So let's say we put a buffer of like 20 trades, meaning if today you take trend, if you hit worst case scenario 20 trades consecutive losses, you want to control it in such a way that if that really happens, you will not exceed your drawdown. Okay, so if your drawdown is 20%, and then let's say you buffer in a 20 consecutive trades, okay, margin of safety, then if you do a simple math, that means that you should not take more than 1% per trade, right? Because if you're going to take 1% per trade, 20 consecutive losses, that will put you at 20% drawdown, okay? Which is still within what you have set in terms of the parameters for yourself, right? So that's what drawdown is in terms of the application aspect, okay? And of course, you would eventually adjust this number as you progress in your journey, but that's something very important. Okay, so last couple of sessions, right, we talk about this framework called DSC, right, which stands for direction and setup, as well as context, right? And we kind of went a little bit deeper into the direction and the setup, right? And we also went into the live market analysis to really show you the application of that. Context, we talk about multi-time frame, right? And of course, risk itself is part of this component of context as well, because you kind of decide like, do you want to trade it? All right, are you comfortable with it? Right? Do you want to take the risk? If you are taking the trade, you're taking the risk. How much are you risking? Okay, how are you going to manage your trade? Are you going to manage it aggressively, or are you going to go for extended target? Right. So that's basically context. Okay. So over here, I also want to give you an idea of like the general structure of how we can define our risk, right? Or we can call it a risk strategy. The simplest one and most commonly used is what we call fixed fractional, which is essentially you fix a percentage per trade, right? This is the most commonly used, right? The good thing about this is, of course, the calculation is simple, and you have the compounding effect, right? But of course, you tend to grow your capital slightly slower, but it's more of a consistent, steady basis, right? And because we are working with percentage on this, if today you have a smaller account, then obviously the dollar amount of growth would also be smaller, right? Because it's percentage. Then we also have the volatility adjusted kind of a risk structure, which is using ATR as your stop, right? So one of the common ones is like if today you want to factor in market volatility, you can say, all right, I'm going to take the ATR with a multiplier effect, and then that would put me, where my stop loss is. And then from there, I can go and calculate my position size, right? This one here, seldom traders actually use it because it's a little bit more challenging in the calculation of things. And then, of course, the ATR can range quite widely, right? So that's something that seldom traders actually take and use this format. The last one here that I have is called the fixed ratio. This is actually very, very good if you are trading maybe one or two instruments, and you're kind of trading them with a setup that has very similar stop loss point. Okay, meaning most of your setup, the stop loss maybe, let's say it's like 15 pips to 20 pips, right? So it ranges always around 15 to 20 pips. Then this risk structure or fixed ratio can be very, very beneficial because it helps you to scale very fast. Okay. But the downside is, of course, if today you're doing swing trade where you're taking multiple different instruments, and each of these instruments, the setup in terms of stop loss can varies in terms of the width, then the calculation becomes very, very complex, right? Then you want to probably just go back to fixed fractional. Okay, so each of these structures has its pros and cons. Personally, I always just use the fixed fractional, okay, because I'm more towards like swing trading and I look at multiple different assets, as well as each of these setups that I'm looking at, the stop loss can range quite a bit, right? So for me, the calculation, the best to use is based on fixed fractional, right, which is the simplest model. Okay, so position sizing, right? This is something I realized a lot of traders are not using or they totally are unaware of. Okay, they would just say, oh, oftentimes they will ask questions like, oh, I have this amount of capital, I trade this. What's the lot size I should be trading? Okay. Whenever you have questions like that, it just means that you don't fully understand the importance of position sizing. You don't understand how to calculate it. Okay. So today's topic is going to be very, very important, right? The universal process is this. Number one, you need to define obviously your risk percentage. Okay, how much risk are you going to risk every time you take a trade? Is it 0.5%? Is it going to 1%? Is it going to be 2%? Now, you want to be consistent on this because if sometimes you risk more, sometimes you risk less, and then you're not consistent, what happens is if the trade that you loses so happen you take a bigger risk, and then the trade that you win so happen you take a smaller risk, then the whole equation is not going to be balanced. Okay, so when you're defining your risk per trade, it's always good to be consistent, meaning you stick to it for sufficient amount of trade. And then if let's say you want to make an adjustment, once you make that adjustment, you want to then again be consistent about it, right? So the first step is always define the risk, okay? And then the second part here is where a lot of traders are not aware. You need to calculate and measure what's your stop loss distance, okay? Meaning from your entry point to your stop loss, what's the width, right? What's the distance? What's the pip count, okay? Obviously, if today you're doing one instrument, one time frame, one setup, oftentimes this is going to be more or less the same, right? If you're, for example, you're doing a 15-minute time frame, let's say gold instrument, on the intraday basis, then oftentimes your stop loss on that is going to be quite similar. But if today you're doing swing trade, right? And then you're trading multiple instruments, like sometimes you trade dollar Canadian, sometimes you trade pound yen, sometimes you trade gold, sometimes you trade S&P. Then your stop loss will be very different because some instruments are more volatile, some instruments are less volatile. Sometimes your stop loss is tighter, sometimes your stop loss is wider. So you need to go and calculate. Okay, now why do you want to calculate this? Because what we are achieving here is we want to maintain consistent risk per trade, meaning Today, doesn't matter what instruments I take, right? Doesn't matter how wide the stop loss is. I want to make sure that every trade I put in, my risk is 1R, right? Which is whether it's a 1% or 2%, right? I want it to be consistent. Okay, so third step over here is basically go and find out what's the exact dollar risk, right? So if today my equity is 100,000, I'm risking 1%, and that's of course 1,000. Okay, then I'll go and calculate my position size, right? Because why? As I mentioned, we want to achieve consistency, right? Meaning every time I take a trade, it's going to be $1,000. Doesn't matter the stop loss width, it's going to be $1,000 risk, right? So from there, I would then need to go and calculate what's the optimum size I should be executing based on the stop loss width, right? So from there, then of course, I go and round to a nice number, right? Because sometimes you will have like maybe 1.2222, right? Then obviously on MT4, MT5 can only put in like up to 2 decimal places, right? So you just round down, okay, accordingly. So this is the kind of process to calculate your optimum size. And the objective, I just want to highlight again, is to really achieve consistency in your risk. Okay, meaning every time you take a risk, it's going to be the same amount. Now, why again this is important? Because number one, as I mentioned, okay, today you want to make sure that every time you risk is the same amount because you don't want to be losing a bigger risk and then winning when you're taking a smaller risk position, right? You want to make sure it's going to be consistent so that this is taking care of itself. Okay, and then with a healthy risk to reward ratio, that's where your win rate, your risk reward ratio comes in, your expectancy comes in. Okay, if your risk per trade is not consistent, then your expectancy formula doesn't work. Okay, and then from there, you will not be able to assess whether your strategy is profitable or not. You will not be able to assess like which elements within your strategy needs to be improved. Okay, so you want to keep as many elements within your whole trading process as consistent as possible so that you can then understand what to work on. Okay, I'll give you an example here, right? So suppose you have an equity of 10,000, right? And you have set your risk percentage is 1%, meaning every time you take a trade, you're going to risk $100. Okay. Now today you kind of analyze the market and you found out that, oh, you have a setup on euro dollar and my stop loss is 25 pips. Okay. So just do a mental math, right? If today you trade one lot, every lot is, oh, sorry, if you trade one lot, every pip is $10. Okay, if you do a micro lot, then every pip is 10 cents. Okay, so what this means is today I have a setup of a stop loss of 25 pips, and for this particular setup, I want to risk $100. So general math here, right? We take $100, divide by 25 times 0.1, which is the micro lot, right? Smaller lot size, 0.01. The formula would give us 40,000 units, right? And that translates to 0.4 lots, right? So what this means is that today, if I have a setup on euro dollar with a 25 pip stop loss, and I want to risk $100, meaning if this trade touches my stop loss, I'm going to lose maximum $100. I can only maximum trade up to 0.4 lots, right? Can follow that thought process, okay? Obviously, there are resources that you can look into, right? So today, if I bring you to, I often use this baby pips, right? You go over to tools and you click on position size calculator, okay? Basically, what you can do is you can, put in the currency account, put in your balance, right? So in this case, if it's 10,000, you risk 1%, you're 25 pip stop. And then of course you can pick the currency pair that you're trading. Of course, depending on the currency pair you're trading, sometimes the position size, but even if it's the same lot size, right? Sometimes your same stop loss, your position size might varies, right? So you don't need to worry too much when you use calculator like that because you basically just input everything that you need to input. You click calculate, right? So the result here says, okay, based on 10,000, 1% is $100. That's your risk. And if this is your stop loss point, the maximum you can trade is 0.4 lots. Okay, now suppose I have another trade which is also on euro dollar, and let's say this time around my stop loss is 35 pips. Right? I click calculate, and you realize that the amount of risk is the same, but because my stop loss is wider, I now need to adjust my lot size to 0.28, such that if I take this position, the worst case scenario, I'm also maintaining $100 risk. Okay, so the thing that you want to keep consistent is this, the amount at risk. Okay, the thing that will fluctuate, right, likely would be a stop loss point, and because of that, your lot sizes needs to be optimum according to your stop loss point. Can follow up to here, yeah. So that's the idea behind position sizing. Okay. Now, with that said, right, I want to touch on this keyword called leverage, because a lot of times traders misunderstand it, right? And they think that, oh, leverage means risk, right? Meaning if today you have a higher leverage, you have a higher risk. But I want to put it here. Leverage is not risk, okay? Position size is how you control risk. Now, leverage, depending on the platforms, sometimes it's higher, sometimes it's lower. But to be honest, if you are managing your risk properly, leverage is not your primary concern, okay? Unless you are trading a small account, and when I mean small account, it's like somewhere between like $100 to $200, right? If you're doing that, then obviously the leverage would come in more significantly, right? Because you would need then the leverage to assess trading, right? Because your capital is very small. But if today you're trading with $1,000 capital and above, right? Leverage, to be honest, is not going to be a major impact. Okay. And doesn't matter if you trade with small leverage or high leverage, how you control risk is basically based on your position size. Okay. How big, how small you can enter. Okay. Now, then there's also this keyword that you need to be aware of, right? It's called margin required, which basically translates to how much money you need to open and hold a position. Okay. I'm pretty sure some of you have heard of the term called margin call. Okay. Um, so how does margin call occur is based on margin required and based on margin level, right? So margin level is basically a very, very quick measurement of your total exposure, right? The higher your margin level is, the safer your portfolio is. The lower your margin level is, the riskier it is, okay? And the whole idea here is when your margin level hits 100% or lower, usually that's where you get a margin call, which means you're not controlling your risk. The broker would then have to forcefully close your losing position to ensure that you have sufficient margin required to maintain your remaining position, right? But of course, again, if today you have proper stop loss, you have proper position size, you have proper calculation of risk, um, all this will be taken care of naturally, okay? The only thing you will encounter all this is because you don't manage your risk properly, okay? So that's a little bit about, all the foundations of risk. Today, if you are trading multiple assets, right? So I just want to touch on this as well. Today, if you're trading on multiple assets, right? You want to also understand risk from a portfolio perspective, meaning you look at market correlation, right? Because sometimes traders would ask questions like, hey, I have a trade on few pairs, and then how come all of them just consecutively or concurrently loses, right, at the same time? Um, when you have that kind of experience means you don't fully understand market correlation. Okay, so what is market correlation is within the currency itself, you have an internal market correlation, and then you have the external market correlation as well, meaning you're looking at currency versus commodities. They have some relationship. Okay, So today, if I give you an example, right, if you look at euro dollar and the pound dollar, these two are positively correlated, which means if one goes up, there's a very high chance the other instrument would go up as well, right? And vice versa. So today, if you look at these two and then you analyze them, and then you have positions of both, okay? And let's say you both have a buy trade, right? So obviously, if something happened in the dollar, then when prices of euro dollar comes down, there's a very high chance GBP USD will also come down. Okay, and then that's where you might experience consecutive losses one after another. Okay, so when you understand this as part of your risk management, you want to account for market correlation. Okay, meaning before you take the trade, you look at this two and then you realize that both have a setup, both you want to trade. Then you need to ask yourself, okay, if I'm going to put 1% on each, then my total exposure will be 2% on a similar kind of a setup because they're correlated. Are you okay with that? Right? If you're not, then there are either one or two ways you can solve it, right? One is you don't take both, you filter it. You choose one, okay, because they are correlated anyway. Number two is you reduce both of these position sizes to maybe 0 0.5, 0 0.5. So when you add them up, you're still risking a total exposure of 1%. Okay, so this is something very, very important, especially for traders who are taking multiple instruments at the same time. Okay, so if today you're trading instruments concurrently that are highly correlated, the suggestion is don't overexpose, right? Maybe if typically on average you're risking like 1% per trade, and then right now you have like two trades that are correlated that you're interested in trading, you might want to not do like 1% plus 1%, right? Maybe you want to do like 1%, meaning 0 0.5, 0 0.5, or you do like 1% and the other one you cut it to half. Okay. Now, if it's uncorrelated, it's still fine, right? Meaning what I mean by uncorrelated today, if you're looking at maybe euro dollar, okay, and then you're also looking at gold, okay. So this two, the correlation is not very, very close. It's fine. You can look at them as independent instrument, right? So if one is buy, the other one is sell, or both is buy, it's fine, okay, because they're not that correlated. Okay, then you can take your typical like 1%, 1%. Now, obviously, you also want to factor in, even if it's uncorrelated, the total exposure at any point in time, right? Because if you have 5 concurrent trades, right, you need to also be aware, and this is very important if today you're also doing prop firm, right? Because they have like maximum daily loss. Um, so if you put in 5 pending orders, then you need to also factor in, okay, if each of it is 1%, then the worst case scenario is if 5 of this end up losing, that's going to be a 5% down. Okay. So you also want to factor in that. Okay. So you realize that in your risk management perspective, okay, a lot of things comes in where we calculate the downside first, right? And I always believe that if today you can manage the downside, the upside will be taken care of naturally. So building your risk plan, right? So this is kind of like a framework, a template for you. The first thing, of course, is to start off with understanding what's your capital and what's your objective. Okay. Um, what's your comfortable risk per trade? Okay. The standard rule of thumb is, 1%. But of course, depending on capital size, sometimes you might be comfortable with it. Sometimes you might feel that's a little bit too low. Okay. Um, so obviously, then you also want to translate that to what's the dollar amount of risk. Okay. At the end of the day, you want to find that balance. Okay. Then you also want to set yourself what's the comfortable drawdown ceiling, right? What's the maximum drawdown you're comfortable with? Is it 20%? Is it 5%? Is it 10%? Is it 50%? Okay. Now, obviously, if you're doing it on your own account, you have the flexibility and the freedom to decide. If you're, working on prop firms, then obviously there are hard limits that you need to follow. Okay, so you want to set all this very clear. Okay, because this is gonna give you the guidance in terms of how you're gonna manage your individual trade respectively, right? And of course, sizing method, right? We kind of share with you there are generally three types of sizing method. One is fixed fractional, one is ATR based, the other is fixed ratio. Okay. Now, my personal take here is if you're looking at smaller account, okay, what I mean by that is somewhere between maybe $500 to $2,000, right? If your account ranges between $500 to $2,000, um, fixed ratio might be something that is interesting to look out for because you can then scale a smaller account faster. But the downside is you need to only pick, or your strategy itself needs to be more or less having a similar stop loss width, right? Meaning every trade you take is $0. Every time you take a trade, your stop loss is around 20, 25 pips, right? It's around the very, very small, similar range. Then this method works. Now, if you're not, then my take is just go towards fixed fractional and that's it. All right. My personal point of view is the ATR stop basis is just too complex, too many moving parts that you need to calculate. It complicates the whole process. Okay. For me, I don't really use the fixed ratio. I only use fixed fractional. Okay. But I'm just telling you, if today you want to scale a small account faster, and if your criteria hits, then you can consider fixed ratio. Okay, now today we might not have the time to go into the details of how to do a fixed ratio management. But if you're interested, you can just do a simple search. There are tons of information available for you to understand deeper what this fixed ratio kind of like money management technique works. Okay. Then you want to set some of your portfolio rules, right? For example, what's your maximum exposure in terms of correlation? Okay. Meaning concurrently, how many trades maximum are you gonna take, right? As I mentioned, if today you're doing prop firm, you have like some very strict and rigid rules. If you're doing it on your own, then of course you have the flexibility to decide on that, right? But my take here, my personal experience is that try not to go more than 3 concurrent trades at any point in time because it will you will be distracted, right? Because you then have too many trades concurrently that you need to take care of. Okay, so try to do it within like 3 trades maximum concurrent. Okay. Then of course there are some traders who put in the rules of like, I'm not gonna take any trades if there's like a tier 1 news, right? Like what is a tier 1 news? Is like NFP, FOMC. Okay. Um, this is not a hard rule, it's just giving you ideas of how you can kind of structure your risk strategy. Okay. Um, so ideas like that you can include it. Okay. Then you have the trade context as well, right? Meaning some trades, sometimes you might want to risk a little bit more, some trades you might want to risk a little bit less, right? Now, I don't really do this, but how I use this principle to how I use this principle is I use it in my trade management. Okay. Because I have generally two types of trade setups, right? One is I trade the pullback, okay, which is then like shorter term. Okay. The other technique setups I trade, right, would be trend following, right? So if today I'm trading a pullback trade, okay, which is shorter term, a little bit more aggressive, I would tend to manage my trade faster. I'll shift my stops to break even faster. I'll just target my first take profit. On the other hand, if today I'm looking at a trend following kind of a setup, okay, I'll also shift my stops pretty aggressively, but I'll actually put my take profit at an extended level, which means I'm aim to go more profits, right? Not just the first take profit level. So this is something you can actually structure in as part of a risk plan, right? I mean, this is where the context part of the framework comes in as well, right? What type, or I would say what trade you're looking at? Is it a retracement? Is it a trend following? Um, will give you that information or help you to make that decision as to how you're going to manage it. Okay, so this is something you can structure it into your risk plan. Okay, Then you have this thing called risk mitigations. Basically, this is the part where I mentioned about shifting stops, right? How are you gonna shift your stops to reduce your risk for an ongoing trade, right? How are you gonna trail your profits? So you realize that all this needs to be in place before the trade takes place itself, because when the trade is running, things can get pretty emotional, right? And you don't want that to be impacted in your decision-making process, right? So you want this to be set out first, then you follow it as you are trading. Okay, obviously it's not like set in stone. You can kind of like tweak it as you go, right? But you do not want to just tweak it when there's a trade ongoing. Okay, so this is like building your trade plan, but very specifically on the aspect of risk. Okay, how do you mitigate risk? How do you manage risk? This is kind of like a segment of your trading plan. Okay, then we have this thing called the Q switches, which is like your hard stop. Okay, meaning if today you're doing like intraday, right? If today you have like 2 consecutive losses within the day, then maybe that's it for the day, right? You want to stop trading for the day. If today you're looking at more like swing trade, right? Maybe you have a weekly stop as well, right? If today you have like 3 consecutive losses in a single week, then maybe you want to stop trading for the week and then come back the following week. Now, again, if you're doing prop trade, then there are very, very strict and rigid rules you need to follow. If you're doing it on your own account, then obviously you have that flexibility in deciding this, okay? So this is generally some of the components you want to include in your risk plan. Doesn't necessarily mean you need to have all of this, but these are some of the ideas that you want to include in and, food for thought, for you to kind of like understand which are some of the components and criteria that you need to have as part of a risk management plan, okay? Good. Now I'm going to give you one example, okay? Then I'll see if you guys have any questions, yeah? Now, I'll use the pound yen as an example, okay? Now, I'm not going to go into the details of like why I'm looking at this setup, right? Because that's where we cover previous sessions about DSC framework, the direction and setup. I'm going to dive into the risk structure, okay, and let you see how what we covered today is being put into practice, okay, to the application aspect. Now, we have a setup here that we're looking to sell the pound yen, okay? So all the setups is there. I'm looking to enter, my technique is based on pending order, right? So I'm looking to enter at the 206 price point. I'm looking to put my stop at 206.85. Okay, which is 85 pips stop loss, and then my target is basically here. Okay, now if you still recall, the steps to managing risk is understand where my stop loss width is, right? How wide it is, right? So in this case here, if I'm going to enter at 206, my stop is going to be at 206.85. That's an 85 pip stop. Okay, now 85 pip stop. Basically, then what I'll do is I'll need to go back to this calculator, right? Today, if I'm doing 100,000, 1% risk per trade, and 85 pip stop loss with a currency pair on GBP JPY, okay, it will tell me that it needs to know what is the dollar yen price. So very, very simple. I'll just go back to my chart, okay, and then I'll find the dollar yen. The price of dollar yen is around 156.2. What I'll do is I'll just go here, 156.2, and I'll key that in. And I click calculate. Now, what happens over here is that it will tell me, okay, based on this, you're risking you're risking $1,000 on this. And if today you want to risk maximum $1,000 on this trade, you cannot trade bigger than 1.8376. Now, obviously, we can't do a 1.8376 lot, right? So what we can do is we can actually either round up a little bit to 1.84, or we round it down to 1.83. Okay, it really depends on your personal preference. Like to me, this one, I'll just do 1.83. Okay, So you can see that the steps to do it, right, really first start off with from the setup phase, how wide my stop loss is, right? Because this trade here, the stop loss is 85. Now, I'll show you another example, right? If today we have a dollar Canadian, okay, now this one here is a little bit early in terms of the setup because price is still quite far from the entry point. But I just show you this, right? I have another potential trade I'm looking at. The entry is 1.4025, the stop is 1.3970. This is a 55 pip stop, right? Again, because I look at swing, my stop loss can varies quite a bit, right? So just now that one is 85, this is 55. So 85, I can trade at 1.83, right? Based on pound yen. Now today, if I'm looking at dollar Canadian, which is a 55 pip stop. Okay, of course it asks what's my price at dollar Canadian. It's gonna be 1.4025, right? 1.425. Click calculate. Then I realize, hey, this position, I can actually take it at 2.55, right? But at the same time, what am I risking? Same, $1,000, right? So I want to keep this consistent, right? And you realize that depending on the currencies you're trading, depending on your stop loss width, your lot size would be calculated differently, right? It's going to be like, this is consistent. This is the one that keep changing. Okay. Meaning if today I'm going to take this trade here in dollar CAD, I can put in a 2.55 lot. Okay. So why do I want to have both of this risking similar 1%? The logic behind is I don't know which is going to win. I don't know if the pound yen is going to win or the dollar CAD is going to win. But just based on this two setup here, I have my target. You know, here you can see risk reward is about 1:2, right? Very close to 1:2. Pound yen here, risk reward is also very close to 1:2. Okay. Now, what this means is that if one of this trade loses, I'm very certain it's going to be around 1,000, right? Because that's what I set. So I know, okay, the downside, the worst case is if I lose 1,000. If I win, it's 1:2, meaning I'm going to win 2,000. Okay. They have different sizes, but they have similar risk structure. So if one win and the other one lose, I know that I'm going to net make about 1R because one is going to be minus 1R, the other one is going to be plus 2R, so net is 1R. Now, if I don't have a consistent risk, meaning one of this trade, I risk 1,000, the other one I risk 500. What happens if I lose the 1,000 and I win the 500? Then the math would not work out, right? So that's the reason why our risk in terms of the dollar amount needs to be consistent so that the other elements like your risk reward ratio is going to come in to benefit you, right? Your win rate is going to come in to benefit you. So that's the idea behind it, right? Now, in terms of management of risk and management of trade, okay, should show you the context of things, right? Pound yen over here, we are looking at a pullback trade. Okay, so what does it mean in terms of my risk structure? I'm not going to go for extended target. Today, if I take a trade here at 206, if the price comes down to 204.30, great, I'll just exit the entire trade because this is a retracement trade. I'm not going for more. I'm happy to take profit at target 1. Okay. Dollar Canadian buy is a trend continuation curve trade, right? Meaning the overarching trend is to the upside. It's not a retracement trade. I'm waiting for the retracement to be completed, then I buy it. So dollar CAD is something that I can say, all right, I'm not gonna just target here. I can go for more, right? So I can base on the forward time frame and say that let's just do a simple projection. Okay, I'll just do a very simple projection. Let's just say if it's a 1:1, this would go towards like 4 to trendy. Okay, meaning my target here I can put at 4,220. Okay, so realize that this particular trade, the risk reward can actually extend towards 3.5, right? Instead of our typical 1:2, I can go for more, I can go for 1:3.5. Okay, so that's the part on the trade management context, right? This is again not something that you need to 100% follow. I'm just giving you ideas of how I'm actually applying the principles that I covered so far. Okay. Now, then of course we also have the exposure element, right? So one is dollar CAD, one is pound yen. Fine, these two pairs are not correlated. I can take them as independent trades, right? I don't need to worry about market correlation or account exposure. But of course, I also need to factor in, okay, if I'm going to take these two trades concurrently, worst case scenario, I can have like a 2% drawdown. So can I accept it, right? If the answer is okay, okay, fine, right? So you can see the process of going through that checklist, right? Making sure everything is checked, is okay, it can be accepted, then we kind of put in the order, right? We execute it. So far, so good. Okay. Good. Very quick one. So far, is there any question? Let me do a quick check. So far, is there any questions that you guys would like to understand? No, all good. Okay, if there is no question, maybe I'll just do a quick wrap up. Okay, for those of you maybe miss out at the start, okay, just want to very, very quickly cover um, that today's session is sponsored by KVB, right? And of course, if you're very new to KVB, there are links in the description tags that direct you to the website. You can find out a bit more about it. You can register for account. Of course, if you have any further inquiries, feel free to reach out to the support team as well. And I just want to bring your attention and awareness to the one of the promotions that they have, which I think is very, very unique, which is the switch bonus, right? Of course, once you log into your account, under the reward section, you can actually find out a little bit more information. But just do a quick introduction on this, right? The promotion is going to run until the end of this year. And the idea of switch bonus is basically today, if you have like other platforms, other accounts that you're using, and you would like to also open an account here, with KBB, you can actually claim this switch bonus, right? You can receive up to 1% and up to $2,000 of this bonus, right? And of course, you also have the double reward segment over here, which of course I won't go into the details of things, but you can give it a read, once you log into your account under the reward segment. And of course, if you have any questions, feel free to reach out to the support team. Okay. So if there's no further questions, I think that's all that I have for today's session over here. I hope you understand a little bit more into what risk management is, how to actually apply that into actual trading, and all the best, right? And we'll see you guys next week. So next week, we will be doing a session, right, on live market analysis and basically applying all the things that we've covered um, into the actual practical environment, right, which you can see and witness the DSC framework being applied into the market, right? How do we analyze direction? How do we look for a setup? How do we apply the context? How do we apply the risk aspect that we covered today? Everything put in place. Okay, so do lock down this date, which is next Tuesday, same timing over here. And then of course at the same time, if you know friends that can actually benefit from sessions like that, do feel free to invite them in as well. Okay. So that's all I have for today's session. Okay. Best, and we'll see you guys next week.